December 11, 2025. The Federal Reserve announces its third consecutive interest rate cut of the year. The federal funds rate drops by a quarter point to a range between 3.5% and 3.75%. Jerome Powell steps to the podium. The message is clear. We are easing monetary policy. We are making borrowing cheaper. Relief is coming. Wall Street analysts nod. Financial headlines declare victory. And then you check your mortgage refinance application. The rate, 6.22%. The same rate it was last week. Actually, slightly higher than it was in October. You refresh the page, thinking it's an error. It's not. Despite 3 Fed rate cuts since September, a cumulative drop of 1.75 percentage points, your cost of borrowing a home loan has not fallen. In some cases, it has risen. If you are confused, you are not alone. Millions of Americans are staring at the same numbers, asking the same question. How does the Federal Reserve cut interest rates, but mortgage rates go up? The answer is not in Washington. The answer is in Tokyo. And what happened on December 10, 2025, in the Japanese government bond market is the economic equivalent of a fire alarm that no one is hearing. Because for 30 years, your mortgage rate was not set by Jerome Powell. It was set by Japan. And Japan just walked away from the table. This is not a story about monetary policy. This is a story about the largest liquidity subsidy in human history and its sudden, violent end. For 3 decades, Japan flooded the global financial system with cheap capital. They borrowed money at 0% interest, sold the yen, and bought U.S. Treasury bonds by the trillions. This was the carry trade. It was invisible. It was automatic. And it kept your mortgage rate low even when the Federal Reserve raised rates. But on December 10, 2025, Japan's 10-year government bond yield hit 1.96%. That is the highest level since 2007. That is nearly double where it was 1 year ago. And that single number just triggered the unraveling of the mechanism that made your cheap mortgage possible. Here is how the machine worked, why it just broke, and what happens next. For 30 years, the global economy operated on a hidden subsidy. Japan set its interest rates at 0, in some cases below 0. The Bank of Japan told the world, you can borrow yen for free. Global investors, hedge funds, pension funds, and sovereign wealth funds took the deal. They borrowed trillions of yen at 0% interest. They sold the yen. They converted the proceeds into dollars, and they used those dollars to buy U.S. Treasury bonds, which paid actual interest 3%, 4%, sometimes 5%. The profit was automatic. Borrow at 0, invest at 4, pocket the difference. Multiply by $1 trillion. This was not a fringe strategy. This became the structural backbone of global finance. Japan exported over $3 trillion in capital to the United States and Europe through this mechanism. That capital did not just sit in vaults. It went to work. It bought U.S. government debt. It suppressed Treasury yields. And because mortgage rates track the 10-year Treasury yield, it suppressed your mortgage rate. When Japan was the government never had to offer high yields to attract investors. There was always a bid. There was always liquidity. There was always Japan. Your mortgage broker never mentioned Tokyo, but Tokyo was paying part of your mortgage bill. The machine worked flawlessly as long as one condition held. Japanese interest rates had to stay at 0. Because if Japanese rates rose, the carry trade stopped working. If you can borrow yen at 0 and invest in U.S. Treasuries at 4%, you make 4% risk-free. But if Japanese rates rise to 2%, your profit margin collapses to 2%. And if Japanese rates rise to 4%, there is no profit at all. In fact, you lose money once you account for currency risk and transaction costs. The moment Japanese yields rise meaningfully, the entire trade reverses. Investors stop borrowing yen to buy U.S. assets. Worse, they start selling U.S. assets to pay back the yen they borrowed. This is the unwind, and the unwind just started. On December 10, 2025, Japan's 10-year government bond yield closed at 1.96%. 1 year ago, it was 1.1%. That is an 86 basis point increase in 12 months. It is the highest yield since 2007, and it is accelerating. Just 2 days earlier, on December 8th, The yield was 1.84%. It jumped 12 basis points in 2 days. This is not a gradual drift. This is a market breaking. Why is this happening? Because Japan is trapped in a debt spiral that makes the United States look fiscally responsible by comparison. Japan's government debt is 263% of GDP. That is the highest debt burden in the developed world. For decades, they survived this debt load because interest rates were zero. Debt service was manageable. But at 1.96%, the math turns violent. Every percentage point increase in Japanese yields adds approximately $27 billion per year to Japan's interest expense. That is not a one-time cost, that is an annual recurring bill. And Japan is already running massive deficits. They do not have $27 billion lying around, so they borrow more, which increases the debt, which makes investors nervous, which pushes yields higher, which increases the interest bill, which forces more borrowing. This is the doom loop, and once it starts, it does not stop. In late November 2025, Japan's new Prime Minister announced a stimulus package worth over 17 trillion yen, roughly $110 billion, to restart the stagnant economy. Normally, when a government announces fiscal stimulus, markets cheer. More spending means more growth. But this time, the bond market did the opposite. Yields spiked. Why? Because the market looked at that $110 billion and did not see growth. They saw more debt issuance. They saw a government that is already borrowing 90% of what it needs to pay its bills, deciding to borrow even more. The market said no. For the first time in a generation, the Japanese government tried to spend its way out of a crisis, and the bond market rejected it. The invisible bid, the Bank of Japan buying its own government's bonds to suppress yields, was overwhelmed by selling from everyone else. This was the moment the subsidy ended. Because when Japan's borrowing costs rise, Japan cannot afford to keep lending to the United States. Here is where the story crosses the Pacific and lands on your mortgage statement. Japan holds $1.13 trillion in U.S. Treasury securities as of March 2025. That makes Japan the largest foreign holder of U.S. government debt. For decades, Japan was the reliable silent partner at every Treasury auction. When the U.S. government needed to borrow money, Japan was there with a checkbook. But now, Japan needs that money back, not because of politics, not because of tariffs, because of mathematics. Japan's own debt crisis is forcing a repatriation of capital. Japanese pension funds, insurance companies, and banks that spent 30 years buying U.S. Treasuries are now selling them. They are bringing the money home to cover losses in their own bond portfolios, to meet margin calls, to pay higher interest on Japanese government debt. This is the liquidity drain. The U.S. Treasury market is issuing record amounts of debt. The Congressional Budget Office projects the U.S. will borrow over $2 trillion in fiscal year 2025. But the buyer who absorbed trillions of that debt over the past 30 years is now a seller. Supply is rising, demand is falling. And when supply exceeds demand, prices fall. In the bond market, when prices fall, yields rise. And when Treasury yields rise, mortgage rates rise. This is why the Federal Reserve cut rates on December 11th. But your mortgage rate on December 11th was 6.22%, barely changed from where it was in September when the Fed started cutting. The federal funds rate, the overnight rate, banks charge each other fell by 1.75 percentage points since September 2024. But the 10-year Treasury yield, which determines mortgage rates, did not follow. In fact, the 10-year Treasury yield has been rising. It closed at 4.19% on December 12, 2025. That is up from 3.6% in September 2024. That is a 59 basis point increase during a period when the Fed cut rates by 175 basis points. The two should move in the same direction. They are moving in opposite directions. This is the paradox. And the explanation is Japan. The Federal Reserve controls the short end of the yield curve, overnight rates. But the long end of the curve, 10-year Treasuries, 30-year Treasuries, is controlled by supply and demand in the market. And the demand side just collapsed because Japan left. Mortgage rates track the 10-year Treasury yield, not the federal funds rate. This is because mortgages are long-duration assets. A 30-year mortgage is a bet on interest rates 30 years into the future. So, lenders price mortgages based on long-term interest rates, not overnight rates. The 10-year Treasury is the benchmark. When the 10-year yield rises, mortgage rates rise. And the 10-year yield is rising because Japan is selling Treasuries. According to data from J.P. Morgan, Japanese investors sold approximately $41 billion in long-dated U.S. Treasuries between January and April 2025. That is a significant acceleration from prior years. And it is not just Japan. China, the second largest foreign holder of U.S. Treasuries, reduced its holdings to $757 billion in March 2025, down from $784 billion in February and $901 billion in September 2022. The foreign bid is disappearing. And without the foreign bid, U.S. Treasury yields must rise to attract domestic buyers. Higher yields mean higher mortgage rates. Here is the cruelest part of the story. The Federal Reserve is cutting rates specifically to help borrowers. They want to make it easier for you to buy a home, refinance your mortgage, or invest in your business. But their rate cuts are being overwhelmed by a force they cannot control: the end of the Japanese subsidy. The Fed controls the price of overnight money. They do not control the price of 30-year money. That price is set by the global bond market. And the global bond market just lost its biggest, most reliable buyer. So, while Jerome Powell cuts rates and tells the American people that relief is coming, the bond market is saying the opposite. The bond market is saying, without Japan, you are going to pay more to borrow, not less. This is not temporary. This is structural. The carry trade that sustained global liquidity for 30 years is unwinding, and it is not coming back. Japanese 10-year yields hit 1.96% on December 10th. Markets are now pricing in a 70% probability that the Bank of Japan will raise its policy rate again at its December meeting. If they do, Japanese yields will go higher. If Japanese yields go higher, more capital will flow out of U.S. Treasuries and back into Japanese bonds. And if more capital flows out of U.S. Treasuries, Treasury yields will rise further, which means mortgage rates will rise further. This is the feedback loop. And it is accelerating. Let me give you the numbers that the mainstream media is not showing you. The average 30-year fixed-rate mortgage in the United States was 6.22% as of December 11, 2025, according to Freddie Mac. 1 year ago, on December 13, 2024, it was 6.6%. So yes, mortgage rates are lower than they were a year ago, but they are not lower because of the Federal Reserve. They are lower because of a brief period in late summer and early fall when Treasury yields dipped. But that dip is over. Mortgage rates bottomed at 6.08% in late September 2025. They have been rising since. And here is the key fact. The Federal Reserve cut rates 3 times between September and December. Yet mortgage rates rose from 6.08% to 6.22% during that same period. That is a 14 basis point increase while the Fed was cutting. That is the opposite of what is supposed to happen. And the reason it is happening is because Japan is draining liquidity from the U.S. Treasury market faster than the Fed can inject liquidity through rate cuts. Now let me show you what this means in real dollars. The median home price in the United States is approximately $420,000. If you put 20% down, $84,000, you finance $336,000. At a 6.08% mortgage rate, your monthly payment is roughly $2,030. At a 6.22% mortgage rate, your monthly payment is roughly $2,060. That is a $30 per month difference. Over 30 years, that is $10,800. That might not sound catastrophic, but that is the damage from a 14 basis point increase. Now imagine what happens if mortgage rates rise another 50 basis points because Japanese yields keep climbing. At 6.72%, your monthly payment jumps to $2,160, a $130 per month increase compared to the September low. Over 30 years, that is $46,800 in additional interest. And if mortgage rates rise to 7%, which they did in early 2024, your payment hits $2,200 $240. That is a $210 per month increase. That is $75,600 over the life of the loan. This is not abstract. This is your money, and it is disappearing into the black hole created by Japan's unwinding carry trade. Here is what happens next. The Federal Reserve will keep cutting rates. They have signaled that they expect to make 1 or 2 more cuts in 2026, but those cuts will not bring mortgage rates down unless something changes in the bond market. And the bond market is not going to change unless the foreign bid returns. And the foreign bid is not returning. Japan is not going back to zero interest rates. Their inflation is running at 3%. Their economy is finally showing signs of growth after 30 years of stagnation. The Bank of Japan is not going to reverse course and restart the carry trade. If anything, they are going to keep raising rates, which means the unwind will continue, which means U.S. Treasury yields will stay elevated, which means mortgage rates will stay elevated. The Federal Reserve is pushing on a string. They are trying to lower borrowing costs by cutting short-term rates. But long-term rates are controlled by the bond market. And the bond market is controlled by supply and demand just collapsed. Here is the broader implication. This is not just about mortgages. This is about the entire structure of American prosperity. For 30 years, the United States borrowed money at artificially low rates because Japan subsidized our debt. We ran massive deficits. We financed wars in Iraq and Afghanistan. We bailed out banks in 2008. We sent stimulus checks during COVID. We never faced the true cost of that borrowing because Japan was always there to buy our bonds and keep yields low. But that subsidy is over, and now the bill is coming due. The U.S. government is projected to run a $2 trillion deficit in 2025. That means the Treasury Department has to sell $2 trillion in new bonds. Who is going to buy them? Not Japan, not China. Domestic investors will have to step in. But domestic investors will demand higher yields to compensate for the risk. Higher yields mean higher interest costs for the government. The Congressional Budget Office projects that interest on the national debt will exceed $1 trillion per year by 2026. That is more than the U.S. spends on defense. That is more than the U.S. spends on Medicare. It is the fastest growing line item in the federal budget, and it is only going to get worse as Japanese liquidity continues to drain out of the Treasury market. This is the hidden cost of the Japan unwind. It is not just your mortgage, it is the fiscal solvency of the United States government. We are entering an era where borrowing costs matter again, where deficits have consequences, where the invisible subsidy that allowed America to live beyond its means for a generation is gone, and the reckoning is going to be brutal. If you are waiting for mortgage rates to fall back to the 3% or 4% levels of 2020 and 2021, stop waiting. Those rates were a historical anomaly created by a global pandemic, emergency Federal Reserve intervention, and the tail end of the Japanese carry trade. They are not coming back. If you are waiting for the Federal Reserve to cut rates enough to bring your mortgage payment down, stop waiting. The Fed does not control mortgage rates. The bond market controls mortgage rates. And the bond market is being drained by the largest holder of U.S. debt repatriating capital. If you are planning to buy a home and you are holding out for better rates, understand the risk. Rates may go lower in the short term if the economy weakens or if there is a crisis. But structurally, the era of cheap money is over. The 6% mortgage rate you see today may be the good old days 5 years from now. Here is what you can do. If you have a mortgage at a rate above 7%, consider refinancing now while rates are in the low 6s. If you are buying a home, do not wait for perfection. A 6.22% rate in December 2025 is significantly better than the 7.22% rate we saw in May 2025. Lock it in. If you are sitting on cash waiting for the perfect entry point, understand that home prices are not falling. The S&P CoreLogic Case Shiller Home Price Index shows that home prices have appreciated 17.6% since the beginning of 2022. Despite mortgage rates doubling, prices are sticky. Rates are volatile. If you wait for rates to fall, prices may rise faster than rates fall, and you end up worse off. If you have investments in bonds or bond funds, be aware that rising yields mean falling bond prices. The 60-40 portfolio, 60% stocks, 40% bonds, is getting destroyed right now because stocks and bonds are falling together. Bonds were supposed to be your safety net. But when the biggest buyer of bonds in history becomes a seller, there is no safety net. This is the new world. The Federal Reserve cuts rates, but your costs go up. The government borrows more, but the bond market demands higher yields. The invisible subsidy that propped up American living standards for 30 years is gone, and most people do not even know it existed. They just know that something feels broken, something feels wrong. The math does not add up. The Fed is easing, but nothing is getting easier. And the reason is Tokyo. On December 10, 2025, Japan's 10-year government bond yield hit 1.96%. That number is not a headline. It is not trending on social media. But it is the single most important economic event of the year, because it marks the moment when the largest creditor in history told the largest debtor in history, "I am done lending. You are on your own now." And being on your own is expensive. Your mortgage rate knows. The bond market knows. The only question is, do you?